Perfect.
Okay, great.
Excellent.
So,
All right, so I'll
go ahead, Tim.
continue. Yep, I'll continue through here. The One Big Beautiful Act overview introduces some new and temporary tax provisions. It also impacts employees, employers, and families. The focus areas, as we mentioned, overtime pay deductions, tip income deductions, employer meal deductions, child savings accounts, the Trump accounts, and then many provisions effective tax year 2025, which we'll talk a little bit about. And just reminding you that provisions are federal income tax changes, so New York payroll and state income tax treatment may not change parallel to this, so that's still to be determined.
Okay, great. Thank you, Tim. So let's get into kind of the meat of today's presentation, which is this overtime deduction. This topic is quite robust, and you may even see it, oversimplified in the news as no tax on overtime. And that's really, like I said, an oversimplification of a provision that has quite a bit of nuance to it. So the point of today's call, we want to make sure you guys have a grasp on really what this new deduction is all about, and of course, what the responsibilities are for you as county employers to ensure that your employees can utilize this new deduction. So let's talk about kind of an overview of the provision and what's eligible, who is eligible, and what type of pay is eligible. So this is a deduction that is available to taxpayers if they itemize or even if they do not itemize. So, colloquially, we could call it an above the line deduction. For super tax nerds like myself, that might be not 100% accurate because of how it interacts with federal adjusted gross income and blah, blah, blah. But it is available to itemizers and non-itemizers. It is a temporary provision, so it's only available as the law is written today for tax years 2025 through 2028. So the interesting thing about that, and we'll obviously get into this in detail as we move through today's presentation, is that, this law, the One Big Beautiful Bill Act, was signed on the 4th of July of last year, 2025. So because this provision is effective for the entirety of the 2025 tax year, there's some retroactivity there that really is what Tim and I have been working with clients to determine kind of how to move through applying this for 2025 and then for future years as well. So what qualifies? It's not all overtime pay that's paid out. It's really specifically keyed to the Fair Labor Standards Act, or FLSA, and only the required amount under that law for overtime. So, in plain language, when we talk about overtime, for many employees, that's, the time and a half payment required after they work 40 hours that week. And it's really that and a half portion. That's the premium portion in excess of the employee's regular rate. That is what they're going to be able to deduct on their tax return. And this is limited as far as who can claim this. So most importantly, only non-exempt employees are able to claim this deduction. So again, we're looking back at the FLSA to determine if an employee is exempt or non-exempt and whether or not they could qualify for the deduction. And then you're going to need to have a valid Social Security number on your individual return when claiming the deduction. And then lastly, the last bullet here is important. So if a taxpayer is married, they are only allowed to take this deduction if they are filing jointly with their spouse. So a married filing individual taxpayer would not be able to claim this deduction. Anything to add on this slide, Tim?
I just had to unmute, sorry.
Okay.
Yeah, no, nothing to add on there, only just to emphasize that a lot of what we talked about on that first slide is from the employee's standpoint, right? Whether they qualify, all that kind of stuff. As we talk more about this, we're going to talk about the reporting requirements, because the counties, obviously, that's what they're worried about. But it's important also to know what we talked about on the last slide and on this next slide to sort of talk about, well, what's when you're getting phone calls from them to understand what's on their side of it.
Yes, yeah, well said, exactly. So here's a couple more kind of overview points for this provision. So there is an annual cap for taxpayers as shown here. And again, you can see the single cap, and that's for someone who's unmarried filing as a single taxpayer, or for married filing jointly, you'll see the joint cap, 25,000 there. Importantly, there is an income phase out. So there are thresholds, as you can see on this slide, 150,000 for a single, 300,000 for joint. When modified adjusted gross income exceeds those thresholds, you'll see that deduction available being reduced by $100 for every $1,000 over that threshold. So that is kind of an important nuance, again, for your employees in the taxpayers specifically. Those phase out provisions and the amounts of the caps will be indexed for inflation in future years. But again, importantly, right now, this is only available 2025 through 2028.
Yeah, and Jess, if I could just make a quick comment too. So why it's important to know all of these different phase outs and caps and such is, while you as a county don't want to get involved in tax advice, right? Your HR and payroll people may be getting a lot of questions as to why someone got the benefit and someone didn't get the benefit. So it's just important for you to know that, you know, whether you qualify for these or whether things are phased out or capped can be different depending upon each of their facts and circumstances. So it's just important for you to know, if your payroll people are getting those questions, they don't want to get into giving tax advice, but they can say, hey, everybody's tax situation is different. So our responsibility as a county is to report it to you. And we'll talk about transition relief, and this year may not have been the best example of that, in terms of you having to report to them, but your responsibility is to report the information. As to whether they qualify, that's an individual thing. And then just sort of the last thing, Jess talked about the time span of beginning in 2025, which was clunky because it was sort of late in the game. We'll talk more about that, but also that 2028 is the final year of this. Now, we've talked, Jess and I have presented on this a few times too. We don't have a crystal ball. We don't know what's going to happen after 2028, but it tends to be politically difficult for somebody to come in and say, we're going to get rid of a deduction, right? So I would say, yes, there's a sunset on this now, but you should put procedures into place with the idea that it may continue.
Yeah, that's exactly it. I mean, we can talk about it being temporary, but I certainly wouldn't advise just, you know, let's patch something together for a few years. It's definitely worth the legwork now to make sure you're doing everything you need to do. And of course, that potential additional extension that Tim's referring to is absolutely something that could happen. Okay, so some tax and payroll considerations for you as employers. So this is a federal income tax deduction only. This is not changing your withholdings. This is not an exclusion from wages, nothing like that. Also, despite what you'll hear when you hear kind of the no tax on overtime headline, there are still taxes applied to this money. So you can see on the slide here, we talk about FUTA and FICA. You're thinking of like your state and local taxes, payroll, Social Security, all of that is still taxed against these wages. There's no change to payroll withholding. The employees are basically claiming this deduction on their 1040s when tax time comes around. So no change to your withholding there. And again, you can see we wanted to always kind of point out the New York wrinkle. So this is federal only, and any of those state or local specific taxes that we've called out in the last slide or others are still applicable here. Okay, so this is really the meat of it and kind of what we've been working towards. So let's talk about the tracking and reporting requirements, because this is really where, as an employer, the concerns are around reporting and compliance here. So tax year 2025, the IRS said, hey, we realize, this law was passed in July and some of this money has already been paid out. So this is going to be a transitional year. So for tax year 2025 only, they did not update the forms W-2 or the 1099s. There was no place for employers to separately report qualified overtime compensation. Because of that, they basically said there's not going to be any penalties on you as an employer for failure to separately report qualifying overtime to your employees. We didn't give you a place to do it. We hope that you will use a reasonable method, and they encouraged employers to assist their employees to help them identify any of their applicable overtime deduction money. But there was going to be no penalties for tax year 2025. So some relief there. When we look ahead to 2026 and after, we already do know that the forms will be updated. We've seen draft W-2 and draft 1099 forms for tax year 2026, and they do include a new box, or I should say a new code for box 14, to report qualified overtime and some of the other new deductions in the law, like tips and the senior deduction, that sort of thing. So I believe the code will be TT as it stands right now in the draft forms, but there's, that's all subject to change as they finalize everything. But we do know going forward, employers will be required to isolate that kind of premium FLSA required overtime number for each individual employee and report it on their forms. So changes will be coming, and this is really, 2025 being a transitional year has allowed, employers to consider how is our payroll system set up? How are we going to calculate this number, isolate only the qualified overtime pay for this deduction specifically, and report it to our employees? Now, this is an important slide for this audience. We wanted to make sure to kind of talk about specifically kind of public sector overtime nuance for this provision. So when we look at FLSA, there are certain additional wrinkles to the law for certain types of employees. So some people on the call will be very familiar with this. Fire, law enforcement, those types of arrangements will often have under the FLSA, instead of the traditional 40-hour-a-week measurement to determine overtime, they may have a work period that spans for a longer amount of time, or an hours total for a 28-day or a month period. And after that threshold is exceeded, that's when FLSA overtime would kick in for those types of employees. So the high level takeaway is the same, only FLSA required overtime pay is qualified for this deduction, but for certain types of positions, that calculation may be different than a traditional 40 hours worked a week. Notice 2025-69 does talk specifically about public sector employees in fire and law enforcement, and of course it also gets into comp time, which I know Tim's very familiar with from his work as kind of an arrangement and is commonly used in your world. And so there is specific IRS guidance about comp time and how that provision or how that arrangement interacts with this FLSA requirement specifically. Ultimately, I would say the takeaway for comp time is that when the comp time is actually paid out, that's when the potential deduction for qualified overtime pay kicks in, and you would be using that a formula of 1/3 to basically isolate that premium portion over time. So that's an important nuance certainly for counties, but really it's, right now looking at these provisions, considering your non-exempt employees, making sure that FLSA required overtime piece is something you're able to isolate and calculate with payroll and HR. And the last point on this slide is really just kind of a communication piece. Like Tim said, you're not, in the business of giving tax advice, but it is important to make sure that those that work in payroll and HR do feel equipped to answer the questions that may come in about this provision. Where do I find my overtime pay? Where on the form is it? Just being at least high level informed on this to be able to answer those questions can go a long way for your employees.
Jess, if we could circle back to your first bullet there, I just want to sort of lay out an example and see if this clarifies what you were saying. So there may be many different contractual bargaining agreements at a county of different employee classes and groups. And to your point, they may be required to work a 35-hour work week, and the CBA may say that if you work over 35, you'll get overtime. And for FLSA, it's really just hours worked over 40 are eligible for the overtime deduction. So if I was under a CBA that said my work week is 35 hours and I worked 40 hours, let's say, I would get 5 hours of overtime, which is perfectly fine per the CBA, makes sense. But none of that would be recorded as eligible overtime to be reported on this. And if that is the case, then if I worked 42 hours, I'd have 2 hours that would be applicable. I'd still get 7 hours of overtime, but 2 hours of that would be what I would record the halftime in this reporting. Is that correct?
Yep, 100%. And that was a really good example and good call out. I'm glad you brought up the CBAs. The way I think of it is if an employee is under a collective bargaining agreement, or if for whatever reason there's an employer that's essentially more generous than the law requires them to be, that's great, but only that mandated FLSA required overtime for those hours worked above 40 hours for that week will be qualified overtime for this deduction. So yeah, great example, Tim. Thank you for that. I think that kind of covers this slide. I'm going to turn it over to Tim to take us through a couple other One Big Beautiful Bill Act provisions we wanted to touch on briefly today.
Yeah, so we definitely, in your slides, you'll have all this information. We're not going to spend a ton of time today on it because it doesn't directly affect you as a county, but it's still part of the bill. So we included it in there mostly for you to be able to go back to, but we'll touch upon a few things here. So one of the areas was the tip income deduction. And so what is it? Federal income tax deduction for qualified tips received during the year. The maximum deduction is $25,000. Says federal only. New York State is still deciding as to whether they will decouple or couple with this. They haven't. I don't believe that there's been talk in the last week or so about it. I don't believe a decision has been made at this point. So let's say for right now we're just saying federal only at this point. It does not reduce FICA or New York State local taxes, so very similar to what we heard on the overtime rules, right? Who qualifies? W-2 employees and independent contractors in occupations that customarily receive tips on or before 12/31/2024. The tips must be voluntary. You've got to have a valid SSN number. Married taxpayers must file jointly. Same as sort of what we saw with the overtime as well. The phase out levels you can see here, similar to what we talked about previously. And then from a reporting and a documentation side, it'll be on the W-2 or the 1090 non-employee compensation or 1099 miscellaneous. So it'll be on those forms. And you'll notice there the penalty relief for 2025 if return statements are otherwise complete and correct. So the penalty relief again was, hey, we enacted this sort of late in the game. We know that you couldn't have recorded this, previous to that, and so they gave that transition relief for 2025.
Yeah, good overview, Tim. I mean, a lot of what you just went through does mirror the overtime deduction. They kind of, built a lot of the provisions the same way for those two. So good to kind of do a quick overview there.
Yep, the employer provided meals and snack deductions. So what changed? It confirmed the rule that most employer provided meals become non-deductible after December 31st, 2025. And meals that generally are non-deductible are meals provided for the convenience of the employer, employer-operated eating facilities. That includes food, beverages, snacks, and de minimis fringes. Some exceptions that were either preserved or expanded. Existing exceptions continue, such as commercial vessels, oil and gas drilling. OBBBA adds certain fishing industry activities. Meals treated as taxable compensation to employees remain deductible, and recreational or social events for non-highly compensated employees remain fully deductible. What's unchanged? The rules for off-site meals, travel meals, employee events, and similar situations. We have our IRS guidance there that still governs the definitions, substantiation, and exceptions. And then just a last planning note there, employers with employee eating facilities should review section 274.0 and 274E8 amounts for food, beverage sold on a bona fide transactions for adequate consideration may still be deductible. So again, a lot of nuances there with the employer provided meals and snacks. I don't think it won't have a direct effect on any of the counties, but certainly something in the bill. Then lastly, the Trump accounts, what it is, new tax favored savings accounts for children under age 18. The Treasury auto creates an account shell. A parent, guardian, adult sibling, or grandparent must activate it. And eligibility, you can see there, children that are born from January of 2025, again, sunsetting in 2028, similar to the overtime. One-time $1,000 federal contribution, not taxable and does not count towards annual contribution levels. And the child must have a valid SSN. So you can see the different contribution levels there that they have, and growth period rules, investments limited to low cost broad US equity index mutual funds, no withdrawals permitted except limited exceptions, rollovers, excess removals, death. And after the growth period, account functions similar to a traditional IRA. So upon withdrawal, earnings and employer contributions are taxable, after tax contributions not.
Okay, great. Thank you, Tim. Let's talk about some action steps for you as employers. So when we think about all of this, kind of what's next for you, for the overtime deduction specifically, which is obviously the big one we wanted to focus on today, again, it's kind of thinking about your payroll and your timekeeping systems. Is it going to be doable with your current setup to really isolate that premium portion of overtime pay specifically? Doing so is going to be hugely important in the future years so that you can easily report qualified overtime to your employees. Again, we have penalty relief for 2025. That's not going to continue in future years. So you're going to want to make sure that you are able to isolate and report that premium portion. However you do so within your payroll system, you're going to want to have some sort of documentation of your methodology to identify that premium portion of overtime pay. Doing this is just really a good practice to have some documentation about the methodology and the decision making, so that if there was ever a question that came up with the IRS, you'd be able to point to, here's what we did. Certainly with most IRS penalty provisions, there's relief available if there's reasonable methods used and not any sort of willful neglect. So you're going to want to always document that decision making. Preparing HR and payroll teams to answer employee questions. We talked about that a little bit on the last slide, but again, that will help everything just go more smoothly if people have, you know, a high level of information about this. And I know Tim and I have seen clients that, you know, take something like this presentation today and create maybe a one-pager to, you know, put up in the break room that explains some of the high level aspects of this provision, talking about that it's only the FLSA, it's not necessarily tied to your CBA, that sort of thing may be helpful to create and post if possible. And then, you know, communication with employees where they'll find the information when they're going to do their taxes. There will be changes on the W-2s and the 1099s, so, you know, where to look and find these numbers will be helpful to communicate to them as well. Anything additional here, you think, Tim?
I have a couple of comments, but I'll wait for after your next slide because I think some of them pertain to that. Yep.
Perfect. So let me do that. Okay, so yes, you're not going to want to treat the new deductions as payroll tax exemptions. We talked a bit about that. This doesn't change, you know, their paycheck, their withholding, that sort of thing. Preserving supporting records for 2025. Because this was a transitional year, you did not have a responsibility to separately report these, you know, these numbers to your employees. If you did, or if you helped them, you know, again, just good housekeeping is recording and preserving those conversations, records, what you use to make those decisions for future years. Coordination across your various groups, departments, and again, you know, some of the specific nuances for public sector employees when we look at fire and police and those different pay periods that may, you know, change the FLSA calculation. Again, you're going to want to have good record keeping there, clear communication. And then, you know, the last two bullets are really important. Watching for future guidance. You know, this is what we do at Bonadio. We're always keeping an eye on what the IRS is releasing, what additional information we have. With this One Big Beautiful Bill Act specifically, I mean, you know, it's 900 pages, but it certainly does not cover every sort of question that can come up about these provisions. So there's tons of post-enactment guidance. I know I mentioned that one notice, but there's others. There's FAQs on the IRS website, and you're always going to want to just kind of keep an eye out if anything changes, especially in future years. And then New York State. So we touched on this briefly, and Tim mentioned, you know, the fact that this is federal only. The state treatment is different. You know, it's interesting with the overtime specifically. I want to just pause here and speak on this for a minute because, like Tim said, there's been talks in Albany about creating a state level provision similar to the overtime or tip deduction. So we'll keep an eye as the budget is finalized and what's happening there. Because the overtime deduction specifically, the way that it's calculated at the federal level, it impacts federal taxable income, but it does not impact federal adjusted gross income. And because federal AGI is the starting point for the New York State calculation for income, that because of that, essentially this overtime deduction at the federal level just simply doesn't hit your state calculation. So because of that, you can kind of consider it essentially decoupled from the provision for the moment. So, I mean, the takeaway being this really is not a state deduction at this point. It does not impact the state calculation in the way that other provisions might need to be added back and that sort of thing. So from a state level, we'll really just keep an eye on if the state enacts any sort of kind of mirror provision at the state level, which has not happened yet. What do you think, Tim? What else?
Yeah, no, thanks, Jess. And you know, I'll just say that whenever I have a question, I go to Jess because I know she probably did read all 900 pages. So, or at least you're aware of any new things that come out too, because that's
Yep.
sort of what Jess does for us. She makes sure she's on top of any of the new legislation that comes out. No, I think those were great points. One thing that I just sort of wanted to, it touches on a few of these points, but I wanted to talk a little bit too is, okay, so we've laid out what the requirements are, or what the effects are for both the employee side of it as well as the employer side of it. And so, we got a lot of questions, right? Jess and I got a lot of questions right around 1099 time and W-2 time. People were calling us and that, and we said, all right, first and foremost, you've got some transition relief for 2025, so you don't have to do anything for your current W-2s and 1099s. But then we started having the conversation of, okay, well, now I will have to do that for 2026. So what do I do? And we have met with a number of different governments, community colleges, counties, cities, schools, and talk them sort of through the process. And we've said, we're happy to meet with you and discuss what we think the approach should be. And in some cases, there's probably, a half a dozen right now that we're working on that they just said, we don't have the expertise to do it. We want you guys to just come on in and do it. But I just wanted to lay out for you sort of what our approach is. It's really a three-step approach in our mind. The first step is really to look at all of your CBAs and memorandums of understanding and look at what are the employment agreements that you have either with individual employees or classifications employees, and say, what are we currently paying overtime on? And then seeing how that mirrors against the qualified overtime under FLSA. So our example that we gave before of, you may start paying overtime on the 36th hour, but you don't really, it doesn't qualify under this standard until you've worked at least 40 hours. Similarly, you may pay in a week where they work over where they have more than 35 hours, but let's say Monday was Memorial Day and they really only worked, the 4 days, and maybe they worked 2 hours over the total 35 that you have, right? You paid overtime potentially, but again, they didn't work over 40 hours. So the first step that we do is we get in there and we look at all your CBAs, your memorandums of understanding. We say, okay, how do you pay overtime right now? And we identify for each of those how the overtime is paid, and then how does that measure up against what is qualified under this provision. So that's our first step. We identify what the differences are. After that, the next step is we say, okay, how do you gather the information, right? So what we found, we are actually working with a city right now that every one of their departments uses a different software. So they're gathering different information with different software packages and providing it in different manners. And obviously those things then are laid out differently in terms of fields and how they gather information. So we look at, how are you gathering it? Now, it could be software. You could have a combination of software programs, and then maybe some people have physical paper timesheets. There can be time clocks, time cards, all different types of things. So the next step is we say, how do you gather the information? And in the way that you're gathering the information, is there a way for you to identify this different time, right? So you might be able to say, yes, we had a total of 7 hours of overtime in our example before, but put in a bucket only the 2 hours that were actually over 40, right? And say, okay, we're still gonna pay overtime on all of this, but we're gonna put in a different bucket this special overtime that has to get reported. And then the last step, the third step is, okay, now that we've identified what's different and what we need to break out, and then how do we gather it? Now the next step is, how do we make sure that it flows into your system? Maybe you have to, in your software, you have to develop another bucket or another reporting piece that says this is the qualified piece of it, right? And so what we're working on right now with that handful of clients that we're working through is those processes, so that before year end, they can be able to gather that information, have it flowing through their system so that it reports from that separate bucket into their W-2, into that, what was it, Jess, box 14, I think?
Yep, that's right.
Yep, and then so that's sort of the process. Jess talked about before about we talked about the sunsetting, and some folks have said, well, maybe I'll just put together an Excel spreadsheet or something like that. You know, that's okay, but you still got to get it into your W-4 or your W-2, and you're going to be doing that for at least another 3 years, and then likely it may continue. So I just sort of wanted to talk through sort of the process of how we look at it. And again, if that helps you, that's fantastic. You know, if you look at it and you go, that I don't know where I'm going to find the time to do that, or I need help with it. First of all, you can always call Jess and I. We're happy to talk to anybody, you know, with questions. But again, you may just say, listen, I just got to get this set up once and for all, and then I can sort of set it and forget it. So those were just my couple of thoughts relative to those last 2 slides. So now just some final thoughts based upon you know, what we went over today, and certainly we're leaving some time at the end here for some Q&A after this. But some final thoughts. These rules create real federal tax planning opportunities for employees in 2025 to 28. So just at a high level, again, that's our time frame. The tax treatment is going to be different for each employee based upon their specific tax situation, but you, from a reporting standpoint, what you have to do is pretty consistent. 2025 is a transition year with temporary reporting relief and reliance on reasonable methods. So Jess talked a little bit about that before. Maybe what you did is you provided to your employees a report that showed, hey, here was your overtime. You know, here's a third of it that may qualify under the new standard, but you had any reasonable method in 2025 to do it. In 2026, they're expecting that you're going to follow the requirements and only report on the W-2 the amounts that are the half-time, 4-time that was paid overtime per FLSA requirements, right? So 2026, you're going to have to report that properly. You should focus on documentation, employee communication, and public sector overtime nuances, which we talked a little bit about with your CBAs and your memorandums of understanding. The biggest practical message: do not confuse a federal return deduction with a payroll or a New York wage exclusion. Right? People might be saying, hey, I've got this overtime, why didn't my withholdings go down, right? It has nothing to do with that, because it's all on your individual tax return. Once it's reported to you by your employer, and now you're responsible for reporting your own taxes. And you know, if you think back to what Jess went over with the phase outs and the caps and all of that kind of stuff, it's going to be different for everyone. Your only responsibility as a county is to make sure that you're reporting it properly to them.
Yeah, great points, Tim. I think, you know, it's good that we're connecting now because, you know, we're moving from this transitional year in 2025 when really the onus was on the employee to determine, am I eligible to take this? What amount am I putting on my return? And now that responsibility is shifting to the employers in future years. So now is absolutely the time to do kind of these action items that we've outlined today. And, you know, there's certainly a lot here. So I'm glad we have a little bit of extra time for Q&A. I think we have maybe 1 or 2 more slides here, Tim.
Yeah, just really, and this is in the slides, so certainly you have it for your information, but you have my contact information up on there. I do consulting for all of our local governments throughout the state. Keely Ann Hines sort of heads up our audit practice for public sector. Tim Ball heads up our entire consulting division. And if you could just slide to the next page there. And then Charlie Wood heads up our information technology practice. So we get a lot of work that we do for governments in the information technology cyberspace. He heads up all of that. And then lastly, Brett Schrader, who handles our outsourced accounting for all of our municipal clients. And so that's where we actually sort of do from start to finish the daily stuff of just doing their, sort of acting as their comptroller. And he heads that up for all of our local governments. So that was really all. I think we hit it right on time to leave the 10 minutes we were looking for to see if there's any Q&A.
Thank you, Tim and Jess. We do have quite a few questions here. I think some of them have been answered as we went along, but I'm going to go through. Some are similar, but some have little nuances to them. But to clarify, if you file separately, you cannot claim the OT credit.
Correct. If you are married. If you are married and you are filing individually, then you cannot claim the overtime deduction. If you are single, you can claim the overtime deduction on your single return. But if you are married, you have to file jointly in order to be eligible to claim both the overtime and the tip deduction.
Okay. And as a comp time question, when you say paid out, that is when they use the time?
Correct. Yes, for the comp time, that's exactly right. It's when they use the time. Correct.
Okay. And I think you gave an example of this, of the 35/40 overtime issue with the FLSA. You would have to breach the 40 to actually have it qualify.
Yeah, I mean, with the asterisks there for the 7K section, fire and police that might use a different work period threshold, but generally speaking, yes, you would have to exceed 40 hours worked, as Tim said, not just if you're getting paid time off or vacation or whatever, you would need to exceed those 40 hours worked in order to hit that qualified overtime pay.
Okay. Can you provide any guidance on the emergency time inclusion in FLSA OT calculation?
Oh, that's a great question. Yeah, that's a good one. It's the same. It's really the same answer, which is, so emergency time falls under that same section 7K in FLSA, and for those 7K employees, so police, firefighters, you're always going to look to that section 7K and essentially determine, is this payout meeting the definition under that section of overtime pay? So for emergency time specifically, that usually is going to qualify for the deduction as long as it does meet that statutory definition under that section of the FLSA, which it usually does as long as you're, again, tying it to the applicable work period and its payment required under the law in excess of that time worked. So short answer is yes, qualified, but you would again want to make sure and double check with the provision, specifically because it's really going to be based on the position that employee holds.
All right, thank you. If the CBA allows benefit time to be calculated for the purposes of OT, is this situation deductible under FLSA OT rules?
You want to handle that one, Tim? Let me think about that. If the CBA allows benefit time, can you read it one more time, Dave?
Could you reread it? Because I was thinking while you were saying that too.
Okay, if the CBA allows benefit time to be calculated for the purposes of OT, is this situation deductible under FLSA OT rules?
So if I'm hearing that correctly, when they say benefit time, I think they're saying, for instance, I have comp time I'm going to use, or I have vacation time I'm going to use, or sick time. If I'm understanding that correctly, when they say benefit time, then again, I would go back to hours worked, right? Did you work over 40 hours in that given week? If I used benefit time as I'm hearing it, if I used, 20 hours of vacation, I've got to reduce the total amount paid by that first to see, did I actually work over 40 hours? So I think if I'm understanding the question, I think that's the answer.
Okay. our law enforcement employees receive a flat rate for overtime rate, which is not calculated as a time and a half premium. Would we determine the premium rate to be reported? How would we determine the premium rate to be reported?
Oh, interesting. Yeah, okay, so yeah, that structure is not ideal for ease of calculation. If you have a flat rate, you're going to have to essentially compare that flat rate to what is required under 7K of the FLSA. So, you know, for that specific period, in this example, you said law enforcement. So you would look at their work period, 14 days or 28 days, and determine essentially what portion of that flat rate that you're paying out is FLSA required. The FLSA requirement is time and a half. So you'll have to essentially do the calculation under the requirement and then bump it up against your flat rate and take the portion that is FLSA required, and that would be your isolated eligible overtime deduction. So you essentially have to do the calculation and determine the time and a half premium that is required, and then, you know, again, compare it to your flat rate. And, you know, hopefully your flat rate is in excess of the required payment under the time and a half rules, assuming it is, because, you know, it's mandated required time and a half. So assuming it is, only the portion that is time and a half, or the premium portion, I should say, the and a half portion is what would be deductible, and then the rest would be ignored. I do think you may run into a compliance problem if you compare those two numbers and your flat rate is lower than the time and a half calculation. At that point, you have potentially a compliance issue with FLSA, and you would want to, you know, talk with legal about what to do there. But assuming that you're paying more generous than the law requires, you're only going to have to deduct or calculate and report to your employee the portion that is premium FLSA required overtime.
Okay.
That was a lot of words, I know, but it's that setup, that's going to be, you're essentially, you have to do the calculation to determine the premium portion, and then that amount will be deductible.
Okay. Can you clarify that even for double time, it is still just the same 1.5 amount?
Yep, it's just the premium portion. So it's the yeah, the and a half. Yep, it's the amount in excess of their usual rate. Mm-hmm.
Is there a website or a place someone could go to get a clear way to calculate the OT premium? You know, for example, the blended rate, something.
Well, no, I don't know of a website. Yeah, that's, I mean, some entrepreneurs should create that, certainly. I think, you know, the answer that you'd get from Department of Labor, Department of Tax is essentially like this, you know, this is all, none of this is new as far as the required overtime payment under Fair Labor Standards Act. So those determinations should have already been made at some point. And so you would look there to determine what their qualified overtime is. I know that's, you know, not necessarily the case. I don't know of a website or a place you could go, unfortunately. Have you seen that, Tim?
Yeah, well, I was just thinking, I have not, and I think it would be difficult, right? Because we've talked about several different, right, double time, time and a half, flat amounts. There's so many different nuances that I think it would be difficult to have sort of a one stop. You really sort of need to create your own.
Yeah, true.
Okay. Is the employer required to report all eligible OT without regards to any deduction limits that may apply to the individual employee?
Oh, that's a great question. Yeah, you can report the total amount to them. In theory, the employee would know their cap and only put that amount on their return. If they did put the entire amount, of course, the government would cap the deduction on their end. So yeah, you would report the entire eligible OT.
Sort of like the SALT deduction, huh?
Yeah. Yeah.
Yeah, the good news for you is, for the counties is, right, you can't be responsible for knowing what everybody's tax situation is and reporting it differently, right? So you just have one way to report it. It's already difficult enough. So yeah, no, you don't have to worry about that.
Okay, given that I think we're getting near the end here at times. So I have one more here. I think we may have answered this partially, but it's related to comp time. So this is just an example. If I worked 4 hours of OT and earned it as comp time, so the premium would be 2 hours, but then I actually use the 6 hours as paid time off, would the 2 hours still count toward the overtime premium deduction?
I was trying to follow along as you were reading, Dave. I believe the answer is yes. Did that sound right to you, Tim, as you were listening along there?
I was trying to follow are these two different things where they earned it versus paid it. But yeah, I think we had an example of the comp, when you get paid out at comp, right? And how do you calculate it? Have you converted it to say, like, let's say I earned 1 hour of comp time. Do you show it as 1.5 hours in your comp, or do you show it at 1 hour at the time and a half? I think that, I guess it's sort of a complex, thing that we'd have to look at how you do it. Dave, I don't know if it's possible, any of the questions that we didn't answer or get through, if you can forward them to us, so we'd be happy to respond to those in some manner as well.
Yeah.
Great, that would be awesome. We'll make sure we send these back to you, and you can, maybe they are lost in transcription on my end a little bit too. So
no, I mean, there's so much nuance and there's so many unique situations. And like Tim said, that's really going to determine the calculation. So yeah, we're happy to answer those questions. Thank you for really good questions today, guys. Great questions. Thank you.
Yeah.
So you kept everybody on pretty much the whole hour, which is great.
Awesome.
That's good. So I think that's it for now. I want to thank the speakers, Tim and Jess, for their time today, and remind everyone that the recording and slide deck being posted on NYSAC website at www.nysac.org/webinar.
Dave, thank you. Thank you for your time and your staff. If anybody's listening and you have additional questions, I will be at the NYSAC conference next week, so feel free to pull me aside.
Great. Look forward to seeing you there.
Thank you all.
Everybody else.
Thanks, folks.